The $20,000 silent alarm in the end of survival mode. Most people think that hitting your first $20,000 is just about having a bigger number on a screen. They think it's a milestone to be celebrated with a better vacation or a down payment on a car. But if we perform a forensic audit on the internal operating procedures of the financial system, we find that $20,000 is not a reward. It is a threshold of power. In the 2026 economy, there is a specific line that separates the customer's bank's profit from and the customers they actually have to compete for. That line is $20,000 sitting in liquid cash. Up until this point, you have been living in what psychologists call survival mode. Every decision has been filtered through the lens of fear and scarcity. You took the first job offer because you couldn't afford to be picky. You stayed in toxic work environments because you were 2 paychecks away from collapse. But at $20,000, your brain chemistry literally begins to shift. Neuroscientists have documented that reaching this level of security reduces cortisol levels, your primary stress hormone, by a measurable margin. You aren't just richer, you are cognitively sharper because your mental bandwidth is no longer consumed by the arithmetic of survival. However, the moment you reach this milestone, the system enters a state of silent alarm. Banks do not want you to stay at $20,000. A customer with $20,000 in a basic savings account earning 0.01% is a gold mine for them, as they lend your capital out at 21% for credit cards. But a customer who understands the power of that $20,000 is a risk to their margin. They will begin bombarding you with limited-time offers for car leases or exclusive credit card upgrades. They want to move you back into the desperation economy, the system that profits from people who have no margin for error. In 2026, $20,000 represents what researchers call the optionality threshold. Below it, you are reactive. You take what the market gives you. Above it, you become proactive. You gain the walk-away position. You can walk into a negotiation with your employer knowing you have 6 to 9 months of runway. That lack of desperation is visible. It changes your posture, your tone, and your leverage. But here is the danger. Most people hit $20,000 and immediately blow it. They trade their newly built financial immune system for a depreciating asset. Today, we are going to implement the sovereignty protocol. We aren't going to look at what you can buy. We are going to look at how to position this $20,000 so that it becomes the bedrock of a life without financial noise. The smart order of operations and the debt avalanche. Now that you have reached the $20,000 threshold, you are no longer just a consumer. You are a capital allocator in training. The biggest mistake people make at this stage is randomness. They throw $2,000 at a hot stock, put $5,000 in a low-yield savings account, and keep $3,000 in credit card debt. This is what I call mathematical sabotage. In the 2026 economy, the sequence of your moves determines the speed of your freedom. We are going to implement the smart order of operations, a step-by-step blueprint designed to plug every leak in your bucket. Step 1. The tactical buffer, the first $2,000. Before you look at the stock market, you must secure your floor. While traditional advice suggests 3 to 6 months of expenses, we start with a tactical buffer of $2,000. Research from Vanguard proves that even this small amount increases your felt financial well-being by 21%. This is the sleep-at-night money. It ensures that if a tire blows out or a laptop dies, you don't have to sell your future to pay for your present. You pay cash, you feel a mild annoyance instead of a life-shattering panic, and you move on. Step 2. Capture the free lunch, the employer match. If your employer offers a 401k match, this is your next destination. This is the only guaranteed 100% return in the known universe. If you earn $60,000 and your employer matches 6%, contributing $3,600 results in an immediate $3,600 bonus from the company. By ignoring this, you are effectively taking a pay cut. In 2026, where every percentage point matters, leaving this free money on the table is an act of financial self-harm. Step 3. Execute the vampire debt, the avalanche. Now we look at your liabilities. If you are carrying credit card debt, you are dealing with financial cancer. With average interest rates crossing 22% to 29% in early 2026, this debt is growing faster than any investment can realistically return. Carrying a $5,000 balance while trying to invest in an index fund that returns 8% is a mathematical disaster. You're paying the bank $1,100 a year to earn $400. We use the debt avalanche method. List every debt by interest rate and throw every spare dollar at the highest rate first. This is a guaranteed return on investment equal to the interest rate you are no longer paying. Step 4. The Swiss Army knife, the HSA. Once the toxic debt is gone, we move to the most powerful yet most ignored investment vehicle in America, the Health Savings Account, HSA. It is the only account with a triple tax advantage. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. By the time you reach retirement, the average couple will spend over $300,000 on healthcare. The HSA allows you to build a tax-free fortress specifically for these costs. In 2026, the strategy is to pay for current medical bills out of pocket, if possible, and let the HSA compound in low-cost index funds for decades. Step 5. Yield capture and the 0.01% trap. As your remaining $20,000 sits in cash, you must audit your location. The loyalty tax is at an all-time high. Big box banks are still paying 0.01% to 0.50% on savings, while lending that same money back to your neighbors at 21%. On $20,000, this inert yet the X cost see unruly times 1,000 a year in lost yield compared to high-yield savings accounts, HYSA, or Treasury money market funds paying 4.0% to 5.2%. Moving your money to a high-yield environment is not an investment, it is a recovery of stolen revenue. In the final part, we will discuss the bridge account strategy, how to navigate the 401k fee trap, and how to reach escape velocity, the point where your money officially starts working harder than you do. We will finish with the Un-harvestable protocol to ensure the banks can never pull you back into the desperation economy. The bridge to sovereignty and the mechanical flip. Reaching $20,000 is the end of the beginning. You have stabilized the ship, but now you must build the engine that takes you to escape velocity. The mistake most people make once they have their emergency fund and match captured is that they put their head down and stop auditing the system. But in the barbell economy of 2026, the middle of the road is a dangerous place to sleep. To truly become un-harvestable, you must implement the final layers of the sovereignty protocol. The 401k fee forensic audit. Most people treat their 401k like a set-it-and-forget-it machine. But our forensic audit of the system reveals a quieter problem, the storage unit rent. As we've discussed, the average investment expense for smaller plans is 1.37% of assets. You might think 1% is a rounding error, but the math is ruthless. A 1% difference in annual fees over 30 years results in a nearly $190,000 difference in your final retirement nest egg. Nearly 41% of participants aren't even aware they are paying these fees. Now that you have $20,000 in liquid safety, you have the cognitive bandwidth to perform a participant fee disclosure audit. Look for the cheapest S&P 500 index fund in your plan, often with an expense ratio as low as 0.04%, and move your capital there immediately. This single afternoon of work can buy you back 5 to 10 years of your life. The bridge account strategy. While the system wants you to lock every dollar into tax-deferred accounts until you are 59.5, the sovereignty protocol requires flexibility. A 401k heavy portfolio is a comfortable tax-advantaged cage. If your goal is to exit the rat race at 45 or 50, you need a bridge account, a taxable brokerage account filled with low-cost, tax-efficient ETFs. This is your freedom fund. It has no withdrawal penalties and no age restrictions. It allows you to harvest tax losses and provides the outside option value that makes you dangerous to any employer who tries to exploit you. By directing your surplus capital here after maxing your HSA and capturing the match, you are building the physical road to an early retirement. Crossing the $25,000 and $50,000 thresholds. As your capital grows past $20,000, you trigger the $25,000 rule. This is the specific line where underwriting algorithms reclassify you from a retail consumer to a preferred entity. Statistics show that a borrower with $25,000 in liquid cash is 40% less likely to default than a borrower with $5,000, even with the same credit score. Banks will stop charging you for the basic infrastructure of banking because they are terrified you will move your leverage across the street. When you reach $50,000, the silent alarm becomes a siren. At this level, your inertia tax, the money you lose by staying in a 0.01% account, becomes so visible that even the most passive saver starts to feel the burn. The mechanical flip and the Munger threshold. The ultimate destination of the SMART order is the $100,000 threshold, often called the Munger threshold. This is where the mechanical flip occurs. Below $100,000, your contributions do 80% of the work. But once you cross this line, the math of compounding officially starts doing more heavy lifting than your labor. Reaching this milestone is mathematically equivalent to finishing 80% of the race to your first million. It changes your financial posture permanently. You move from a state of dependence, where you accommodate the system's terms because you have to a state of optionality, where you evaluate the system's offerings against your own self-funded alternatives. The sign-off. The $20,000 in your account isn't just money. It's the first brick in your bridge to freedom. The system relies on you being too stressed and too stretched to do this math. They want you to stay high engagement, profitable, but never wealthy. By following the SMART order of operations, you are opting out of the desperation economy. You are becoming unremarkable by external measures, but remarkable by internal ones. True wealth is the silence of a life without financial noise. It is a Tuesday afternoon that belongs entirely to you. If this forensic audit changed how you see your first $20,000, hit that subscribe button. We are dissecting the hidden equations of the economy every week to help you stop being the crop and start being the owner. I'm Dave, and I will see you in the next one.